Today we're talking to Jourdan, who manages the TB Amati Small Cap Fund. Thanks for joining us.
Pleasure.
What's the investment philosophy behind the fund?
Well, it's a fund which invests from pretty much in everything outside the FTSE 100, and it's been around for quite a long time. It's really, I suppose, our basic approach is if you're going to buy a small company, in our view, you're really doing it because you're looking for something which is growing faster than most big companies can grow. So it's a growth-oriented fund. But having said that, that covers a very wide range of investment types and company types. So the very idea of an investment philosophy itself is a complex thing, and it tends to get boiled down to growth or value. But if we had to choose between one of those two, it's probably growth, but I'd like to say it's a bit more complicated than that.
And in terms of the market cap, what's the range of companies that you invest in?
We go up to everything outside the FTSE 100. So I mean, at the moment, our largest stock has a market cap of just under £3 billion. But the fund is really oriented a little bit down from the market cap spectrum from that. So the median investment is £245 million. The weighted average is just over 500.
Now, what percentage of stocks do you hold in AIM?
We're about 50% invested in AIM. And that's AIM, as I'm sure you know, has its sort of controversial component to it, and people scratch their heads a lot about AIM. And one of the things I often say about the AIM market is that a fund like this doesn't have to have anything in the AIM market. We very much choose to have some investments in the AIM market, and I suppose it's because we think there's a set of really interesting growth businesses in the AIM market which we want exposure to, and very often they're less well known and less well researched than those in the full list. And so we're attracted to them on valuation grounds, really.
What sort of characteristics do those companies have?
Well, it's very diverse. I mean, the feature of the AIM market is it covers an enormous number of different activities and an enormous number of different geographies. So it's quite hard to generalise, and we do invest in AIM in all the sectors of the market.
But I've seen before you've categorised the stocks into, I think it was types of animal.
Well, I mean, it was a metaphor really for
Yes.
just trying to encapsulate a little bit about how we think about different companies. We have 5 different types of vertebrate animal classifications. So you're starting with your fish, which are the companies where it's very difficult to communicate with them. And typically these are in overseas jurisdictions, and maybe the management team doesn't speak English. Then there's a sort of a related category, but it's a half and half category of what we call amphibians, where maybe they're overseas companies, but they've got UK boards, or there might be UK businesses that operate overseas. And then the most controversial category is the reptiles, where these are the companies that are really pretending to look like something, and if you invest in them, they're likely to bite you. They're cold-blooded. They have no feeling for what your interests are. They're only really looking after an interest which is not yours. And then there's the birds and the mammals, and the birds are really companies which begin from an egg, and that egg needs to be incubated for a long period of time. And so these are the companies where there's quite an act of faith at the beginning. They're not profitable when they start off.
The investor watching this will be thinking, oh my God, why is he talking about animals? I want to hear some names.
Yeah, you want to hear about some stuff. Well, let me just carry on. And then there's the mammals. Yeah. And the mammals are more conventional type of businesses where typically when you start them, they're going to be profitable from day one. Right. There might be service companies, there might be retail businesses, there might be restaurant businesses. Just to give us some examples. So, I'm thinking of proven technology companies. A couple come to mind. One is a company called Accesso, which we're big holders of in various of our funds. It's a company that's been around for a long time. I'd say it didn't have to go through a very long incubation period, but it was based around an invention, and the invention was to do with a form of electronic queuing. And it started life as a company with a name Low Q, just a single letter Q. It was a bit of a lifestyle business for a long time, but actually the sign of its quality was that even as a lifestyle business, it did okay. And normally if you don't put a lot of drive into a business, it's going to fold. This business kind of had enough good qualities to it that it did okay without being really revved up. And then about 5 years ago, there was a change in strategy, brought in a new chief executive who really then sort of globalised and beefed up the sales strategy of the company. And the product was the same for quite a long time, but the sales then started to really pick up. And since then, they've done some acquisitions and they've broadened out their product offering, and they've moved from being quite a tangential supplier of a product to the products are sold to theme park operators.
So it's just a queuing device. I remember it when it was.
Yeah, it was originally just a queuing device.
Right.
Now they don't just sell queuing devices to Legoland and other places like that. They're selling ticketing, so they'll sell you the tickets before you get there, the car parks. They do the online retail offering for the theme parks, and that's really Accesso's business. And then in the States, they have an ERP, an enterprise resource planning software division, which is actually in some cases operating whole resorts in the US. So a lot of the ski resorts, they're providing the software which really runs the whole resort. That's a good example of sort of proven technology company that's then got the right sort of management and strategy to go places. A couple of years ago, we backed from IPO a company called Quicksand, and it's actually now the largest holding in our small cap fund, and it's a big holding in both the VCTs that we run. And this is a very niche business. It's actually was profitable from the day that they started it, and it's focused on providing the computers that go into gaming devices. So it's a very narrow market of the computer industry, but it's highly specialised, and they've become pretty much the best in the world at designing and speccing these computers. And there are a lot of regulations they have to meet. They've been innovative. They've created some patents. They've got one of the best design teams in the world for this kind of computer, based in Taiwan, where for some reason the best computer designers live in Taiwan. Don't ask me why that's the case. And they've made a fantastic success of this business. And at the moment we think they have about a 4% market share of their potential. So we think there's a huge amount of growth to come for that business.
Are technology stocks an area of specialism for you?
Quite a big area, yeah. We tend to be overweight in technology stocks, and I suppose one of the reasons for that is that we're pretty focused on looking at the barriers to entry for a business. And one of the most obvious barriers to entry will be how strong is intellectual property, and that more often than not boils down to some technological development that a company has, or particular expertise that it might have. And in today's world, it's something that the UK is very good at. So we see a lot of that.
And what other characteristics typically would you look for in a company that's that you're likely to invest in?
Well, so beyond other kinds of barriers to entry would be a strong brand,
right?
Or it might be a very, very entrenched position in a particular niche market. And more often than not, that goes with a brand as well. We like businesses that have been around for a long time, that have got longevity about them. And it's a very strong attribute if you find it in a small company. Where we like companies where they have an opportunity to roll out an idea. So in the retail space, if you've got a good format and you've proven it can work in one area, then a very good business strategy, a well-proven business strategy, you roll that out across the country. Obviously you require a lot of expertise to do that, property expertise. But it's a well-trodden pathway for many companies.
And what else puts you off investing in a company?
In terms of the kind of the warning signs we look for in businesses, and they really emanate from it. You can sort of define them by thinking about what happens when a business goes wrong. Well, maybe the management team running the business take their eye off the ball. Perhaps they've become a bit less ambitious and they want to spend a bit more time on playing golf than they do running the business. And so they're not really thinking, or they just missed a trick and there's an industry development they haven't spotted. So then what happens is the numbers don't quite work out. And different companies respond to that situation in different ways. Strong management teams will give investors very early sight of that, and they'll say, look, we've seen there's a problem, we've thought about it, we've sat down, we're going to fix it. That's great. That's ticking the box. Yes, it's a shock, but they're dealing with it. But more common, and unfortunately more common, is you go into a kind of denial, say, well, that's just a blip, it's not really happening, I don't believe it. And we can bring forward a bit of revenue here, and we can maybe get this sales out the door a bit quicker, and it will all look fine this year, and we'll make it up next year. So then you kind of you tweak the accounts a little bit, and the accounting is an art with quite a lot of discretion. Well, some discretion involved in it, and it's possible for most businesses to either lay off a bit of profit to next year or bring forward a bit of profit in some way, but it shows up in the numbers somewhere.
Is capitalisation of R&D, is that one thing that you watch out for?
It's an open door for this, really. Capitalisation of R&D is a classic for a fairly discretionary way of either increasing or decreasing your profits. We fought long and hard in the late 90s, early 2000s to get capitalisation R&D removed from UK accounts. It went out of UK GAAP, so I'm sure you remember. And then in their massive wisdom, the IFRS, International Financial Reporting Council, decided to put it back into the new IFRS standards. So it's now all over the place again. And it's A, very confusing, and B, I think quite misleading for a lot of small company investors. We will normally strip it out and say, how profitable would this be if it wasn't capitalising any R&D? Because that's the cash trading number. R&D is a cash expense.
Yes.
So we will always adjust our numbers for that.
And are there any other kind of red flags that you would get to name?
Yeah, I mean, accruals is the other big area that we have to scrutinise quite a lot. It's really how much cash is going into working capital, and do you really, if a lot of cash is disappearing into working capital, are you really convinced that the turnover was if you like, honest turnover? And because in the extreme cases, companies trade profitably, and then they go bust. And the reason they go bust is because they've got no cash. It's all gone into working capital. And then somebody comes along and says, hang on a minute, those sales, they never really happened, and they get unwound, and we get restatements of previous accounts with a much lower sales number. So in accounting, you can choose, when you choose to book revenue recognition is a huge area that has to be looked at pretty hard. The kind of largest and most blatant example, I suppose, over the past year was, if you look at the accruals in Quindell's accounts, where you have a massive revenue line, but really quite a lot of uncertainty about whether those revenues are ever really going to be booked. And it's a judgment, and they convinced in order to take one particular judgment, as investors we would like to take a more conservative judgment about revenue than that.
Even some analysts were being absurdly optimistic about it. I was quite surprised.
Yeah, I mean, there's always a temptation with accounts that you say, those are the numbers, I'm going to go with that. So, but when you spot some red flags, and you pick up some red flags, that you then have to get a lot more forensic and ask many more questions about the nature of the booking of revenues. If they're not turning into cash, you need to know exactly why not.
Did you ever hold Quindell?
No. I remembered the Quindell's former existence in Innovation Group.
Right.
And so I never spent much, I never contemplated owning it. There's a certain element in which, things, the stock market is a wheel, and things kind of go around, they come around again. And if you remember them last time, you're less likely to make the same mistake twice. And there is a kind of rule of investors don't typically make the same mistake twice, or they don't make their last mistake again. I wish the market had a longer memory in some ways.
For new people coming into the market, let's say younger people, it's almost it's so easy to make big mistakes that will cost you, hard-earned capital. Yeah,
it is very easy, and I guess if you're investing in small companies as a private investor, I'd say probably the best bit of advice I could give you would be to get plugged into a network, because there are some really great private investors in small companies in the UK, and ones that we in Amati we've got to make quite a lot of friends amongst those very active private investors in small companies, and they do a great job, and there are really interesting networks of private investors which are always happy for new people to get in touch. So,
and any that you'd recommend a new investor who's watching this, or someone who's just thinking about getting into stocks?
Well, there's my good friend David Stredder at Mello, who's runs a very enterprising, engaging group of investors, and we chat to them a lot, and we cooperate with them and share events, and they do a good job of educating private investors and putting on opportunities for companies to meet private investors directly. I think they do a great job.
Any other advice you'd give private investors?
I think if you're going to invest in very small companies, then you really, it requires another level of expertise again. So I'd probably say avoid companies that are capitalised, but let's say less than £100 million, and stick with things a little bit more known quantities. And actually, maybe even more important than that, and maybe 100 million is too high, because there's a lot of very interesting companies worth capitalised below that. But maybe more important than that is to look at companies which have been around for quite a long time, where you can look at a track record, and you can something that you can touch and feel and say, okay, this was the track record, this is how the thing worked out over the last 5 years, and let that give you the confidence. Because without that, you you're really going to need to meet the management. You're going to need to do quite a lot of behind the scenes work.
Thank you very much.
Yeah, pleasure.